Have you ever wondered why so many people who spent their entire lives building wealth suddenly lose it all after retirement? You work for 40 years, save diligently, follow every piece of conventional advice, and then, just when you need that money most, it vanishes in a market crash. The devastating truth is that the same investment rules that helped you build wealth in your 30s and 40s can destroy you in your 60s and 70s. And here's what nobody in the financial industry wants you to know. They're still giving you advice designed for someone half your age. Think about it. When you walk into a financial advisor's office at 65, what's the first thing they show you? A colorful pie chart. 60% stocks, 30% bonds, 10% cash. It looks scientific, it feels safe. They'll tell you it's age-appropriate and properly diversified. But has this ever happened to you? You follow that advice perfectly and then watch your retirement savings drop 30% in a single year. Suddenly, that beautiful pie chart doesn't seem so comforting when you're trying to figure out how to pay for groceries. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. Here's the uncomfortable reality that Wall Street doesn't want you to understand. Those traditional allocation models you've been following, they're not designed to protect your wealth. They're designed to look good on paper and keep you invested so your advisor keeps earning fees. When you're 30 years old, with decades of earning potential ahead, you can afford to ride out a market crash. You can wait 10 years for your portfolio to recover. But when you're 65 and living on a fixed income, you don't have 10 years. You need that money now. The financial services industry has created an entire mythology around asset allocation. They've convinced millions of retirees that if you just spread your money across enough categories, domestic stocks, international stocks, bonds, real estate investment trusts, commodities, somehow magic will happen and you'll be safe. But stay with me until the end, because what you're about to discover might completely change how you think about protecting your retirement wealth. These predetermined formulas treat every 60-year-old exactly the same. They don't care if you have $300,000 or $3 million. They don't ask whether you need income now or can wait 5 years. They certainly don't consider whether the market is absurdly overvalued or offering genuine bargains. They just plug your age into a formula and spit out percentages. It's investing by algorithm, and it's why so many retirees find themselves in financial trouble, despite doing everything they were told to do. What if everything you've been taught about retirement investing is actually designed to benefit everyone except you? What if there's a completely different approach, one that's worked for some of the world's wealthiest investors, that nobody talks about because it doesn't generate fees? The hidden truth that transforms everything is understanding the fundamental difference between looking smart and being smart. Every quarter, your fund manager sends you a beautiful report showing how they've rebalanced your portfolio to maintain optimal allocation. They moved 5% from stocks to bonds. They adjusted your international exposure. They tweaked your real estate holdings, and you're supposed to feel impressed by all this activity. But here's what's really happening behind the scenes. They're rearranging deck chairs on the Titanic, making moves because a computer model told them to, not because anything intelligent is actually being done with your money. This is the mindset shift that changes everything. When you're building wealth in your working years, percentages make sense. You're accumulating, dollar cost averaging, thinking long term. But the moment you retire, you're in a completely different game. You're no longer in accumulation mode, you're in preservation mode. And preservation requires a totally different way of thinking. You need to start thinking like an owner, not like someone following a formula. Does this investment actually make sense right now? Or am I just doing it because some allocation model says I should? Let me share something that might sound radical, but represents one of the most important revelations in retirement investing. There are times, sometimes lasting years, when the smartest thing you can do is absolutely nothing. When stocks are absurdly overpriced, when bonds are yielding practically zero, when real estate has turned into a speculative bubble, your allocation model doesn't care. It forces you to stay fully invested across all these overvalued assets because that's what the formula demands. You've essentially systematized stupidity. You're being forced to buy high simply because a predetermined percentage says you must. Now, I want to go even deeper into this concept because it challenges everything you've been taught about staying invested. What if the right allocation for your retirement portfolio right now is 100% cash? Not because you're afraid, not because you're trying to time the market perfectly, but because you're being patient and disciplined, waiting for genuine opportunities instead of forcing your money into overpriced garbage. This is where the transformation in thinking becomes crucial. Cash isn't lazy money sitting on the sidelines. Cash is potential energy. It's optionality. It's power waiting to be deployed when the world offers you something that actually makes sense. The investment world will tell you this approach looks peculiar, even reckless. They'll say you're not properly diversified. They'll worry that you're taking on concentration risk. But here's the reality that nobody wants to acknowledge. Some of the most successful investors in history have ignored these conventional rules completely. They've put 80% of their wealth in just a handful of investments when those investments made overwhelming sense. They've loaded up on assets that Wall Street considered toxic when the price was right. They didn't care about looking conventional. They cared about actual results, and that's the impact this different mindset can have on your retirement. You stop worrying about appearances and start focusing exclusively on what actually protects and grows your wealth when you need it most. If this kind of straight talk about retirement investing is what you've been looking for, make sure you're subscribed to the channel. I create content that cuts through the industry nonsense and gives you practical wisdom you can actually use to protect your wealth. This journey away from conventional wisdom isn't comfortable. It means accepting that sometimes your portfolio will look strange compared to your neighbors. It means having the courage to hold cash when everyone else is chasing returns. Write in the comments, value over percentages, if this resonates with you. There's a revelation that comes with experience, something you can only truly understand after you've made enough mistakes with your own money. The financial industry wants you to believe that safety comes from owning a little bit of everything. They'll put you in 50 different stocks, 20 different bonds, various real estate funds, international exposure, emerging markets, you name it. And when you look at your statement, you see this impressively long list of holdings that makes you feel sophisticated and protected. But here's what's actually happening behind that complexity. You don't truly understand a single thing you own. This is where the transformation in approach becomes absolutely critical after 60. You're no longer in the game of accumulating assets. You're living off these assets. Every decision you make has immediate consequences for your daily life. Can you really afford to own 50 companies you know nothing about? Think about it this way. If someone asked you to explain what any of those companies actually do, how they make money, what competitive advantages they have, could you answer confidently? Or are you just trusting that because your portfolio is diversified, everything will somehow work out? The journey toward true financial security in retirement isn't about spreading yourself thin across countless investments. It's about concentrating your attention and capital on a handful of things you genuinely understand. Quality over quantity becomes your mantra. When you deeply understand 3 or 4 investments, when you know exactly why you own them, what risks they face, And what would make you sell? You're actually far safer than owning 30 things you can barely name. This isn't reckless concentration. This is intelligent focus. And it's a mindset that most people never develop because they've surrendered their thinking to categories and formulas. Speaking of formulas, let me share something that might shake the foundation of everything you've been taught. The moment you start following rigid allocation frameworks, you've given up the most valuable asset you have, your independent judgment. These algorithms and models can't think, they can't evaluate whether a particular investment makes sense in the current environment. They just follow predetermined rules. But you have the ability to look at a situation and decide whether it's intelligent or stupid. You can say no when something doesn't make sense, regardless of what category it falls into. No computer algorithm will ever match disciplined human judgment that knows when to act and when to walk away. And here's where the impact of this different approach becomes deeply personal. When it's your own money at risk, money you can't replace because you're not earning a paycheck anymore, everything changes. You think more clearly. You become naturally more conservative, not out of fear, but out of wisdom. You stop making moves just to feel active. You only act when the odds are so overwhelmingly in your favor that passing up the opportunity would be the real mistake. This is the hidden advantage of managing your own retirement wealth instead of delegating it to someone who doesn't feel the pain when things go wrong. Every dollar in your retirement account represents hours of your life, years of work, sacrifices you made along the way. When you truly internalize that reality, your decision-making process transforms completely. You stop chasing yields. You stop worrying about missing out on whatever everyone else is buying. You start asking the only question that matters. Does this genuinely makes sense for me right now, given what I know and what I need? That clarity, that ruthless focus on what actually matters rather than what looks good on paper, is what separates retirees who thrive from those who merely survive. Put down "my money, my decisions" if you're ready to take back control of your financial future. Let me pull back the curtain on something that's happening to your retirement savings right now, something so embedded in the system that most people never even notice it. Every single quarter, money is quietly disappearing from your account, not because of market losses, not because of bad investments, but because of fees. And here's the truly insidious part. These fees get paid whether your account goes up, down, or sideways. Your financial advisor gets their cut regardless of whether they've made you a single dollar. It's the most brilliant business model ever created, but it's absolutely devastating for retirees. Think about the psychology behind this for a moment. When someone gets paid the same amount whether you succeed or fail, where's their incentive to take care of your money like it's their own? If they make a mistake and your portfolio drops 30%, they're not losing sleep. They're not scrambling to figure out how they'll pay their mortgage. They just write you a letter explaining that what you experienced was market volatility or temporary underperformance or some other sanitized phrase that sounds sophisticated but really just means they lost your money, and then next quarter they collect the same fee they always did. This is the hidden truth about how most retirement wealth gets slowly bled away, not through dramatic crashes, but through the steady drip of fees attached to mediocre performance. The transformation that needs to happen in your mindset is understanding that when you manage your own money, there's no place to hide. You can't blame the algorithm. You can't point to a benchmark and say you beat it by 0.5% while still losing money. You either made intelligent decisions that grew your wealth, or you didn't. That pain you feel when you make a mistake, that's not punishment, that's education. It's the most valuable feedback loop you can have because it forces you to learn, adapt, and improve. This brutal honesty is exactly what the investment industry has designed itself to avoid, but it's precisely what you need when you're managing money you can't afford to lose. Now, I want to go even deeper into why this matters so much more after 60 than it did when you were younger. During your working years, bad performance meant maybe you retired at 67 instead of 65. Annoying, but manageable. After retirement, bad performance means you're eating ramen at 75 because you ran out of money. The stakes are completely different, yet most people are using the same investment approach they used when they were 40. The impact of getting this wrong isn't abstract anymore. It's immediate and personal. Here's where the real revelation comes in about who you should trust with your financial decisions. The biggest advantage in investing isn't having the highest IQ or the most sophisticated models. It's having your interests completely aligned with the person making the decisions. When someone's personal wealth rises and falls with yours, they think differently. They don't chase quarterly performance targets to impress some committee. They don't buy risky assets just to appear active. They protect capital like it's their own, because it is their own. This alignment is worth more than all the fancy degrees and certifications combined, yet it's the one thing most advisory relationships completely lack. The journey toward true financial security in retirement means finding this alignment. Whether it's by managing your own money or working with someone whose compensation is directly tied to your actual results, not just keeping you invested. Because at the end of the day, you don't need someone who can explain why you lost money using impressive vocabulary. You need someone, even if that someone is you, who treats every dollar like it matters. Write in the comments, alignment over credentials, if you're starting to see how backwards the traditional system really is. There's something fascinating that happens in the financial world that you need to understand, especially after you've retired. The entire industry is built around movement. Every trade generates a commission. Every rebalancing creates activity. Every new investment product launches with fanfare and fees attached. Your portfolio manager sends you monthly reports showing all the adjustments they made, all the tactical shifts, all the sophisticated maneuvers they executed on your behalf. And you're supposed to feel like you're getting your money's worth because look at all this activity. But here's the uncomfortable reality. All that motion isn't compounding your wealth. It's compounding their fees. If you found value in what we discussed today, hit that like button. It helps this message reach other people who are tired of conventional advice that doesn't work for retirees. The mindset shift that changes everything is recognizing that activity is the enemy of retirement wealth. When you were younger and building your career, being proactive made sense. Take action, make moves, stay busy. But with your retirement savings, the opposite is true. You need careful, deliberate decisions that prioritize one thing above all else, not losing money. Notice I didn't say making money. I said not losing it, because after 60, preservation becomes more important than growth. A 30% loss doesn't just mean you need a 43% gain to break even. It means you might never recover those funds during your lifetime. The math gets brutal when you're living off your savings rather than adding to them. This is where having genuine skin in the game creates a completely different decision-making process. When a mistake directly impacts your ability to pay bills next month, you think differently. You become naturally conservative, not from fear, but from wisdom. You develop what I call the pain test. Every bad decision hurts immediately and personally, teaching you lessons that no book or seminar ever could. This natural alarm system is something professional money managers never experience because they're playing with other people's funds. When they mess up, they write an explanation and collect their fee anyway. When you mess up with your own retirement money, you feel it in your gut. That discomfort, that accountability, is actually your greatest protection against stupidity. Now, I want to go even deeper into one of the most dangerous traps that destroys retirement wealth: the seductive appeal of leverage. The financial world loves to dress up leverage in fancy clothing. They'll call it optimizing returns or efficient capital deployment or enhanced yield strategies. But strip away the jargon, and leverage is simply borrowing money to make bigger bets. And here's what happens with mathematical certainty. Leverage transforms small mistakes into catastrophic losses. It always finds the arrogant investor who thinks they're smart enough to control it. You might be right 9 times in a row, feeling like a genius, and then on the 10th time, the market moves against you, and suddenly, you're not just losing your gains, you're losing your original capital. The transformation in thinking that protects retirees is understanding that your goal isn't to maximize every opportunity. Your goal is to avoid permanent capital loss. Being occasionally boring, holding cash when others are chasing returns, owning simple investments when others are getting clever with derivatives and margin, beats being occasionally bankrupt. Because bankruptcy at 65 doesn't mean starting over, it means your retirement is over. The impact of one major leveraged mistake can undo decades of careful saving, and there's simply no time left to rebuild. This is why the smartest retirement investors often look unsophisticated to Wall Street. They're not trying to impress anyone. They're trying to sleep at night, knowing their money will still be there in the morning. Type boring beats bankruptcy if this resonates with where you are on your financial journey. Let me share something that completely contradicts what most people think about courage in investing. The financial media loves to celebrate the bold risk takers, the ones making aggressive bets and swinging for the fences, but that's not courage. That's just gambling with a nice suit on. Real courage, the kind that actually preserves and grows retirement wealth, looks completely different. It's having the emotional stability to stand absolutely still when everyone around you is panicking or getting greedy. It's watching your neighbors brag about their cryptocurrency gains or their hot tech stocks and calmly saying, "No, that doesn't make sense for me." That kind of quiet strength, that willingness to look boring or even foolish in the short term, becomes your most valuable asset after 60. The journey toward true financial independence in retirement requires you to develop this almost Zen-like patience. When the market is euphoric and everyone's talking about easy money, courage means sitting on your hands. When the market crashes and people are selling everything in panic, courage means having the discipline to evaluate each situation on its merits rather than following the herd off the cliff. This emotional stability isn't something you can fake or force. It comes from having clarity about what you own and why you own it, which brings us to one of the most misunderstood concepts in all of investing. The hidden truth about diversification is that it's been weaponized against retirees. The financial industry has convinced people that safety comes from owning as many different things as possible. 50 stocks, 30 bonds, a dozen mutual funds, some international exposure, maybe some alternatives thrown in for good measure. And when you look at that massive list of holdings, you feel protected. But here's the revelation that changes everything. Owning 50 mediocre businesses doesn't protect you. It guarantees mediocrity. You've diversified your ignorance instead of concentrating your knowledge. True diversification, the kind that actually works in retirement, means owning a small handful of genuinely excellent businesses that you understand deeply, bought at prices that make sense. Quality over quantity isn't just a nice saying. It's the difference between thriving and barely surviving when you're depending on these investments for your actual living expenses. Now, I want to go even deeper into this concept of understanding what you own, because it's where most retirees make their biggest mistake. There's this number floating around in investment circles. People should own somewhere between 20 and 50 different stocks to be properly diversified. But nobody ever asks the critical question, can you actually understand 20 to 50 different businesses? For most people, the honest answer is no. Maybe you can truly understand 3 or 4 companies. Maybe if you're exceptionally diligent and experienced, you could genuinely understand 10, but 50, that's impossible. You're not diversifying at that point. You're just collecting names and hoping for the best. The transformation in mindset that protects your retirement is accepting that your circle of competence has limits. And that's not a weakness, it's wisdom. After 60, pretending to understand businesses you don't is far more dangerous than concentrating your wealth in the few you genuinely do understand. When you deeply know a company, how it makes money, what threatens it, why customers choose it over competitors, you can make intelligent decisions about when to buy more, when to hold, and when to sell. But when you own something just because it's in an index or because your advisor needed to fill out a sector allocation, you're flying blind. And flying blind with retirement money is how people end up working at 75 because they can't afford not to. Put quality over quantity in the comments if you're ready to simplify your approach and focus on what you actually understand. There's a moment in every investor's journey where they have to choose between following the rules and following their conviction. And this choice becomes absolutely critical after 60 because you don't have margin for error anymore. Let me paint you a picture of what real conviction looks like. Imagine putting your entire net worth into stocks during a period when you found genuinely screaming bargains. Businesses trading for less than their actual value, opportunities so obvious, they almost felt like mistakes. Most people would call that reckless. Most financial advisors would have a heart attack. But if you deeply understood what you were buying, if you'd done the work to know these businesses inside and out, that's not recklessness. That's calculated conviction. And there's a massive difference between the two. The transformation that needs to happen in your thinking is recognizing that conviction based on deep knowledge will always outperform blind compliance with allocation rules. Those rules were written by people who don't know you, don't know your situation, and certainly don't know what specific opportunities exist right now in the market. They're generic formulas designed to keep you from doing something catastrophically stupid, which is fine if you're completely clueless. But if you've actually done the work to understand what you own, those same rules become handcuffs that prevent you from acting on genuine opportunities. Here's the hidden truth about diversification that nobody wants to admit. It's not a strategy for getting rich. It's insurance against being stupid. When you don't truly understand what you're doing, spreading your money across many investments reduces the damage any single mistake can cause. That's valuable if you're ignorant. But if you've actually developed expertise, if you've put in the time to deeply understand a few excellent businesses, then excessive diversification stops being protection and starts being a limitation. You're diluting your best ideas with mediocre ones just to satisfy some arbitrary rule about how many holdings you should have. Now, I want to go even deeper into where real opportunities actually hide, because this is where your life experience becomes an enormous advantage. Value doesn't announce itself with fireworks and headlines. It hides in boring places that everyone else ignores. It shows up in unfashionable industries that younger investors think are outdated. It appears during moments of panic when everyone's running for the exits. And here's where being 60 plus gives you an edge that 30-year-olds simply cannot match. You've lived through enough cycles to recognize that today's panic is tomorrow's opportunity. You've seen enough booms and busts to know that the crowd is almost always wrong at the extremes. The impact of this wisdom is that while younger investors are chasing whatever's hot and exciting, you can be methodically investigating the boring, unpopular corners of the market where genuine value accumulates. You have the patience to wait for quality to go on sale. You have the experience to recognize the difference between something that's cheap because it's broken and something that's cheap because it's temporarily out of favor. This isn't about taking huge risks. It's about having the confidence and knowledge to zig when everyone else is zagging. Right, experience is my edge. If you're starting to see how your years actually give you advantages that younger investors don't have, there's a game being played in the investment world that you need to stop participating in immediately, especially after retirement. It's called the benchmark game, and it's completely divorced from reality. Your financial advisor will proudly tell you that your portfolio beat the S&P 500 by 0.3% this year. They'll show you charts demonstrating how you outperformed some arbitrary index, and you're supposed to feel successful. But here's the revelation that changes everything. If you lost 15% while the market lost 15.3%, you still lost money. Congratulations. You drove slightly slower than everyone else on the way off the cliff. The mindset transformation that protects retirement wealth is understanding that you don't need relative performance. You need absolute returns and capital preservation. When you're living off your savings, it doesn't matter one bit whether you beat some index if your account value is dropping. You can't pay your mortgage with relative performance. You can't buy groceries with bragging rights about outperforming a benchmark. What matters is whether your wealth is growing in actual dollar terms or at minimum staying stable enough to support your lifestyle. This shift from playing Wall Street's comparison games to focusing on your actual financial reality is one of the most liberating changes you can make. But here's where it gets even more interesting. The journey toward true financial security requires something that seems contradictory on the surface. You need to be both consistent in your principles and completely flexible in your tactics. Think about this carefully. Some of the most successful long-term investors have owned entirely different types of assets in different periods. All stocks during one decade, then mostly bonds in another, then back to equities when conditions changed. That's not inconsistency. That's intelligent. Adaptability. They're not changing their core philosophy, which is always to go where genuine value exists. They're just recognizing that value moves around. After 60, this ability to adjust your approach as market conditions shift becomes essential for survival. Being rigidly stuck in one strategy because that's what worked 5 years ago is how people get crushed. Now, I want to go even deeper into something that sounds almost counterintuitive, but provides real protection. The market, in a very real sense, is always watching patterns. When investors become predictable, always buying at certain times, always rebalancing on schedule, always following the same playbook, they become exploitable, not by some conspiracy, but simply by the mechanics of how markets work. If everyone knows you'll be a buyer of bonds every December for rebalancing, guess when bonds get more expensive? The hidden advantage of maintaining some unpredictability in your approach is that you're not telegraphing your moves. You go where others don't expect. You buy when it makes sense, not when a calendar says you should. You hold cash when everyone expects you to be fully invested. This flexibility isn't about being random. It's about not being a robot that others can anticipate and exploit. Type flexible but focused if you understand how being adaptable while staying true to core principles gives you an edge in protecting your retirement wealth. Let me share something that completely inverts conventional wisdom about how retirement portfolios actually succeed. Everyone talks about balance, having the perfect mix of this and that, keeping everything in harmony, never being too concentrated in any one area. But here's the hidden truth that successful investors have known for decades. Portfolios don't win through perfect balance. They win through decisive imbalance. When you find something that genuinely makes sense, when the opportunity is so clear that passing it up would be the real mistake, that's when you need to act meaningfully, not timidly putting 2% of your portfolio into it, actually committing enough that it matters if you're right. And then, when nothing makes sense, you do absolutely nothing. This rhythm of concentrated action followed by extended periods of inaction is the real art of retirement investing, but it requires a level of confidence and patience that most people never develop. The transformation in thinking that protects your wealth is understanding what true diversification actually means. It's not about avoiding volatility. Markets go up and down, and that's just reality. It's about avoiding stupidity. Real diversification is owning the right things for the right reasons at the right time. Notice those qualifiers: right things, right reasons, right time. Not just owning things because they fit into predetermined categories or because some formula says you should. After 60, this clarity about why you own what you own becomes infinitely more valuable than following any diversification formula ever created. Because when you know exactly why each investment is in your portfolio, you can make intelligent decisions about when to add more, when to hold steady, and when to walk away. Now, I want to go even deeper into perhaps the most underappreciated advantage you have as a retiree: the power of patience. Think about this for a moment. You've spent 40 or 50 years working, building your career, raising a family, accumulating wealth. You've earned the right to be patient. You don't need to prove anything to anyone anymore. You don't have a boss demanding quarterly results. You're not competing with colleagues for a promotion. This freedom from external pressure is an enormous advantage that you need to leverage, not squander. The stock market operates on a simple but profound principle. It transfers money from the impatient to the patient. Every single day, somewhere in the market, someone is panicking and selling at exactly the wrong time. Someone else is getting greedy and buying at exactly the wrong price. Someone is making a move just because they can't stand doing nothing anymore. And all of that impatience, all of that restless energy, creates opportunities for those who can simply sit still and wait. Wall Street desperately needs you to be active because every transaction generates fees. They need you to feel like doing nothing is somehow failing. But the reality is that doing nothing is often the most profitable action you can take, especially when markets are overheated or when opportunities aren't obvious. Put "patience pays" in the comments if you're ready to embrace the power of strategic inaction instead of letting Wall Street pressure you into moves that benefit them more than you. There's a moment of clarity that comes with age and experience, and it's one of the most valuable insights you can have about money. Not every period in the market requires action. In fact, most periods don't. There are long stretches where everything is overpriced, where no genuine opportunities exist, where the intelligent move is to simply do nothing at all. But doing nothing feels uncomfortable. It feels lazy. It feels like you're missing out while everyone else is making money. And that discomfort is exactly what Wall Street counts on to generate their fees. The hidden truth that transforms your retirement strategy is this: when there are no good opportunities, the most profitable action is inaction. Patience literally preserves your capital until real opportunities present themselves. And having the wisdom to recognize this distinction is what separates those who thrive from those who merely survive. Let me tell you about something that happened in the investment world that shocked almost everyone because it was so rare. A highly respected investor named Howard Marks actually sent money back to his clients when he couldn't find good opportunities anymore. Think about the implications of that decision. He could have kept that money under management, continued collecting his fees, and just parked it somewhere mediocre while pretending to add value. That's what almost everyone else does. But instead, he demonstrated a level of professional integrity that's almost extinct in modern finance. He admitted when there was nothing intelligent left to do and returned the capital. This is the standard you should demand from anyone who advises you in retirement, not someone who needs to keep your money invested to justify their fees, but someone who has the honesty to say when it's time to simply wait. Now, I want to go even deeper into what waiting actually means in practical terms. There's this perfect analogy from baseball that captures the essence of intelligent investing. When you're at bat in baseball, you have to swing at pitches in the strike zone or you'll strike out. But in investing, there's no called strikes. You can watch pitch after pitch go by, bad opportunities, mediocre opportunities, slightly overpriced opportunities, and nothing happens. You just keep waiting. And then eventually, a pitch comes right down the middle of the plate, so perfect that even an average hitter can knock it out of the park. That's when you swing, and you swing hard. The impact of this approach becomes critical after 60 because you simply cannot afford to strike out trying to hit every pitch. When you were younger, striking out meant maybe you had to work a few more years. Missing opportunities meant delayed gratification, but in retirement, striking out can mean running out of money with no way to earn it back. This is why the journey toward financial security in your later years requires embracing what looks like inactivity. You're not being passive, you're being selective. You're waiting for opportunities so obvious, so clearly in your favor, that the risk of losing money becomes minimal. Right, selective beats active if you're starting to understand how waiting for the right opportunities protects your retirement better than constantly trying to stay busy in the market. Let me challenge something that's been drilled into your head for decades. The idea that cash sitting in your account is somehow wasted money. The financial industry has convinced everyone that cash is a drag on performance, that it's lazy capital that should be put to work immediately. But here's the revelation that changes your entire perspective. Cash isn't a burden. It's optionality. It's power waiting to be deployed. Think about what happens during market downturns. While everyone who's fully invested is watching their portfolios shrink and feeling paralyzed, the person holding cash has choices. They can act when others are forced to sell. They can buy assets at distressed prices while everyone else is panicking. For retirees, maintaining adequate cash reserves provides something invaluable, both security for your immediate needs and flexibility to take advantage of opportunities when they inevitably appear. But here's where most people sabotage themselves, and it's one of the most common ways retirement portfolios get destroyed. They can't stand boredom. They have cash sitting there earning minimal interest, and it drives them crazy. They start thinking about all the potential returns they're missing. They see neighbors talking about their latest investment wins, and eventually they crack. They force that cash into mediocre ideas just to feel like they're doing something. This is how most portfolios actually die. Not from ignorance, not from bad luck, but from pure boredom. The investor couldn't tolerate the discomfort of holding cash during a period when nothing made sense, so they invested in something that sort of made sense, and that's when the losses started piling up. The transformation in mindset that protects retirement wealth is learning to embrace boredom, actually learning to love it. Because those boring periods when you're holding cash and nothing's happening, those are often the most profitable periods of all. You're not losing money in overpriced markets. You're not getting caught in bubbles that are about to burst. You're preserving your capital so it's available when genuine opportunities arrive. After 60, accepting that boredom is not just acceptable, but actually desirable, becomes one of your greatest competitive advantages. Now, I want to go even deeper into understanding the difference between inactivity and indecision, because people confuse these all the time. Indecision is when you don't know what to do, so you freeze. That comes from laziness or confusion or fear. But inactivity, true strategic inactivity, comes from discipline. It's making a conscious choice not to act because the conditions don't warrant action. You've evaluated the situation, you've done the analysis, and you've concluded that the smartest move is to make no move at all. Knowing when to act. and when not to act separates professionals from gamblers. And this becomes especially crucial when you're managing retirement funds that you cannot afford to lose. The journey toward financial security isn't about making the most moves. It's about making the right moves and having the discipline to do nothing the rest of the time. Type discipline over activity. If you're ready to embrace strategic inactivity as a core part of your retirement investment approach, there's a powerful metaphor from poker that perfectly captures what successful retirement investing actually looks like. Professional poker players don't win by playing every hand dealt to them. They fold the vast majority, sometimes 99 out of 100 hands, and only bet meaningfully when they have a genuinely strong position. The amateurs do the opposite. They can't stand folding. They want to be in on the action. They convince themselves that mediocre hands might work out, and slowly but steadily they lose their chips. This same psychology destroys retirement portfolios every single day. People feel like they need to be constantly invested, constantly doing something, constantly participating in whatever the market's offering. But the hidden truth is that you win by being incredibly selective. When you're past 60 and capital preservation matters more than anything else, this selective approach isn't just smart, it's essential for survival. The transformation that needs to happen is understanding that your job isn't to play every opportunity. Your job is to recognize the rare situations where the odds are so overwhelmingly in your favor that not acting would be the real mistake. Everything else? You fold. You wait. You preserve your capital for when it really counts. This discipline, this willingness to pass on 99 mediocre opportunities to capture the one exceptional opportunity, is what separates those who maintain their wealth from those who slowly watch it erode. Now, I want to go even deeper into something that explains almost everything wrong with the investment industry. There's a simple principle that once you understand it, you'll see through every pitch, every product, every recommendation that comes your way. Show me the incentive structure and I'll show you the outcome. When someone is paid based on assets under management, they'll always want more assets to manage. When someone is paid per transaction, they'll always recommend more transactions. When someone gets a fee, whether you make money or lose money, they have zero incentive to take care of your wealth the way you would. This isn't about them being bad people. It's about the system being designed backwards for retirees. The impact of this misalignment becomes devastating when you're living off your savings. Every unnecessary trade, every rebalancing that serves no real purpose except generating activity, every new product they convince you to buy into, all of it feeds what I call the fee machine. The industry has brilliant marketing that calls all this activity value-added services. But here's the brutal reality. It's value subtracted. Every transaction costs you money. Every layer of fees compounds against you instead of for you. And over the course of a 20 or 30-year retirement, these seemingly small percentages can consume a massive portion of your wealth. The journey toward protecting your retirement means becoming ruthlessly aware of where your money is going. Not just where it's invested, but who's taking a cut along the way, and whether that cut is actually earning you anything. After 60, you need to minimize unnecessary transactions and eliminate fees that don't deliver proportional value. This isn't about being cheap, it's about being smart. Every dollar paid in unnecessary fees is a dollar that can't compound for your benefit. Right, question every fee if you're ready to scrutinize exactly where your money is going and ensure that everyone touching your retirement savings has their incentives properly aligned with actually helping you succeed. There's something almost magical that happens when you remove perverse incentives from your investment decisions. Suddenly, about 90% of the stupid ideas that seemed plausible just disappear. When you're not trying to justify fees, when you're not trying to look busy, when you're not measured by quarterly performance, clarity emerges. The transformation in thinking is profound. You start making decisions based purely on whether they make sense for your actual situation, not whether they fit some external expectation or feed someone else's business model. This freedom to think clearly, without the noise of misaligned incentives clouding your judgment, becomes absolutely essential for retirement investing success. You're finally able to ask the only question that matters: will this genuinely help me, or is it just activity disguised as progress? And this clarity leads you to one of the most counterintuitive insights about when real wealth gets built. Everyone wants to invest when markets are exciting, when headlines are screaming about new highs, when neighbors are bragging about their returns. But that's precisely when opportunities vanish. The real money, the wealth that actually transforms retirement outcomes, gets made during the boring times, when markets are quiet, dull, forgotten, when nobody wants to talk about stocks because they've been going nowhere for months or years, when everyone's either euphoric and blind to risk or miserable and blind to opportunity. After 60, you have something invaluable that younger investors lack: the emotional maturity to act counter to the crowd. You've lived long enough to know that today's panic is tomorrow's opportunity, and today's euphoria is tomorrow's regret. Now, I want to go even deeper into this pattern of crowd behavior because understanding it gives you an enormous edge. Markets are driven by human emotion, and human emotion always overshoots in both directions. When things are going well, people don't just become optimistic, they become irrationally exuberant. They start believing that risk has been eliminated, that prices will rise forever, that this time is genuinely different. And when things turn bad, the same crowd doesn't just become cautious, they become paralyzed with fear, convinced that everything is collapsing and will never recover. Your job as a retiree managing your own wealth is to stand calmly in the middle of this emotional chaos. When they're ecstatic, you become skeptical. When they're terrified, you become opportunistically greedy. When they're bored, you become quietly confident. This isn't about being contrarian for its own sake. It's about recognizing that crowds are almost always wrong at the extremes. The hidden truth that ties all of this together is something you've lived through personally if you've been around for 6 or 7 decades. Despite periodic crises, recessions, wars, financial collapses, panics of every variety, the long-term trajectory of progress, particularly in America, has been consistently upward. You've seen this with your own eyes. The system, for all its flaws, rewards enterprise and innovation. After 60, you have the perspective that younger investors simply cannot possess. You know that panic creates value because you've watched it happen multiple times. You know that the apocalyptic predictions never quite materialize the way people fear. The journey toward retirement security isn't about betting on doom. It's about betting on continued progress while being smart enough to take advantage of temporary setbacks. Put progress over panic in the comments if you understand how your life experience gives you the confidence to invest when others are paralyzed by fear. If you've made it this far, you're clearly someone who thinks differently about money and retirement. You're not looking for get-rich-quick schemes or the latest hot investment tip. You understand that protecting wealth after 60 requires a completely different mindset than building it in your 30s and 40s. And that awareness, that willingness to question conventional wisdom and think independently, is exactly what separates those who thrive in retirement from those who struggle. Everything we've talked about today, from ignoring rigid allocation rules to embracing strategic patience, from questioning fee structures to acting counter to the crowd, these aren't just theoretical concepts. They're practical approaches that have protected and grown wealth for some of the most successful long-term investors in history. The question is whether you're ready to apply them to your own situation. To stop following formulas that were never designed for your actual needs and start thinking like an owner of your financial future. If this conversation resonated with you, if you found yourself nodding along and thinking, finally, someone's being honest about this, then do me a favor and hit that subscribe button. I create content like this regularly because I believe people deserve straight talk about money, especially when they've worked their whole lives to build what they have. No hype, no sales pitches, just practical wisdom you can actually use. And leave a comment saying, "This was meant for me, so I know you made it all the way through." I read every single comment, and it helps me understand what's connecting with people who are on this same journey towards smarter retirement investing. If you found value in what we discussed today, go ahead and hit that like button. It costs you nothing, but it helps this message reach others who need to hear it. People who are tired of the conventional advice that serves everyone except them. Now, there's something else I think you need to see. There's a video right here that takes what we discussed today even further, showing you exactly how to implement these principles in practical terms. Click and continue with me over there, because what we've covered today is just the beginning of thinking differently about your financial future.